Hello, MorAlpha followers. How is everybody today? All right, today is Monday, April 6th, and there were technical difficulties at my streaming host, Lightstream. Um, and I had my own little technical difficulty too that caused me to start a little late. And that is that I took a nap before the show started, and I woke up right around showtime. So I decided on a about a 30-minute delay. Then when I came to get online, there we go. When I came to get online, I could not. And now my monitor is not registering anything. But that's okay. That's okay. The monitor is, it's not clear from my monitor if everything's working, but I think it is. So we're going to go through this show, and it's going to be fantastic. Oh boy, I'm low on water. During the show at some point, I won't be surprised when I take a break to shoot over to the water supply I have in the next room here. Okay. All right, so let's get into this. We have this fantastic presentation prepared for you. So let's get into it. Let's get on the right screen. There we are. Oh, that looks great. Um, I'm going to keep it in this view, and I think I'll be okay. All right, here I go. Well, that's too blanky, so we're going to go for um, a checking in here. That looks good. All right, there we go. Pardon if there's any noise in the background. There could be a little bit of noise in the background today. Not much. It's very quiet here, but once in a while. Okay. So let's go to our fantastic presentation, and here it is. We're going to go to full screen on this and get into it. So before starting, I'm not a broker, investment advisor, financial planner, investment manager, hedge fund, or investment bank. I don't make any explicit investment recommendations. Please consult with an investment professional before you make any decisions. And I'm unaffiliated and independent. I work for you, nobody else but you. Before I get into the show today, I'm going to remind us of something. I have had this slide up many times in past shows. And I want to remind everybody, we are the leaders of the investment revolution. Look at the bottom right of your screen, down there. You see that I dot R dot? That stands for Investment Revolution. 2019 was a unique year in the history of investing and the human history of investing because it started thousands of years ago. Oh, I have something. I have a pad on my chair. I do not want for the show. I'll check where I am here. Let me check where I am on the screen. I might not like where I am. Oh, yeah, that's right. That's where I want to be on the screen. Okay. Back to full screen. And the day of online investing for everyone has dawned. We are here to alert and educate you. There are accounts online available now where you have something you never had before, no minimum balance to open the account, and no commissions when you buy many types of investments, most critically stocks, which is what our show is all about today. So you can buy stocks without paying 1 penny of commission for the first time in history now. But in the past, you'd call a broker, you'd pay him a big fat commission, and if you had a small portfolio, well, you wouldn't even bother investing because you'd spend any profits you made in your portfolio paying for commissions. No longer true. Now you can have $1,000 instead of just letting it lie there dormant in your checking account or earning 1 or 2% in a CD account. You can buy stocks, and you can do it on your desktop, on your laptop, and on a tablet or on your cell phone, right? Click, 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 click. Let's see if the monitor is working yet on this. Every show I go in here and I test the monitor, and right now it's not letting me have access to the monitor, but oh well, I'll continue. Do a quick check. Everything looks good here in the streaming program. I've learned to check those things. My microphone is working. Okay, all right, here we go. Let's get into this. All right, this is going to be a great show. Great show. This is a great presentation. Capital stock. There is a share of General Motors Corporation stock. The way they looked when they issued paper certificates. You can buy a paper certificate now. It'll cost you $500 to order a paper certificate. So few people would do it, but I do recommend you might want to do that if you've left somebody a large portfolio as, say, an inheritance or a gift. And symbolically, I think buying them a share of stock they could put on their wall would be a beautiful thing, a certificate. Anyway, here's our roadmap. Ready? We're going to get into this. We're going to start off with a coronavirus update, but we're going to have our typical updates, coronavirus, market. I'm going to go through something that I think could be illustrative and tremendously helpful for you if you are trying to get a grasp for something very simple. Some common sense thinkers will say to themselves, why should I buy stock? Why should I trust my money to people I don't know and get out into that market that has all these enemies in it, investment banks and hedge fund traders? And I hear my friends, some of them tell me they make money in the stock market, but maybe that's filtered because those who are losing money don't ever tell, and those who are making money can't wait to tell. So this will help you have a comparison between an everyday kind of an investment like a restaurant and buying stock. And then having said all that, we'll really get back to the whole point of today's show. What is a share of stock? What are financial statements and why do they matter if you own stock? What is a theoretical stock price? And we end really with how do we end up with the actual stock price that we get in the market? And then we also have a nice little piece, a beautiful piece on how stocks are created. So let's get into our coronavirus update. See that? Nice, huh? Coronavirus update. Here we go. Before we get into that update, we're going to do a big picture look at human population and human history, because when we see gigantic numbers, I did a whole show called Huge Numbers, sometimes we don't really get what's a big number and what's a small number. So I think a great way to have perspective about all these gigantic statistics that you're being hit with all day, hammered on the head with statistics about coronavirus is, well, how big is the world? How many of us are there? In the world, right now, there are actually 7.8 billion people, but this chart that I found, that I just grabbed off the internet, this data I grabbed off the internet, went up to 2015. It's a little low in the early years. Between 1 AD and, take a note, by the way, the scale here is not even. The scale goes back 70,000 years, but then it has huge leaps before AD 1, which would be the first year of Christ's life. Then after that, it breaks into much shorter periods per slot. Nevertheless, very illustrative, very good chart. And it gets us up to about 2015. It gets us up to 2015 when the world had 7.2 billion. And notice Asia had 4.4 billion. Why? Well, they have China and India, and there are over 1 billion people in each of those two countries. Africa really surprised me when I looked at this because there are over 1 billion people in Africa, 0.7 billion people in Europe in 2015, a little more now. Okay, and about 10% more now, maybe. Latin America, 0.6 billion. That includes Mexico, North America. That really is U.S. and Canada, 0.35 billion, because we have about 300 million at that point, and 50 million in Canada, roughly. Oceania is islands that are starting from, say, Hawaii, Tahiti, down toward Australia, that whole group of islands that are there. That's a very, compared with the rest of the Atlantic and Pacific, it's a more populated area. Anyway, 40 million people in that area, and they covered that in this chart, so in this data, so it's in the chart. And here's a neat thing to look at. It's good to look at, we've got to go to full view, or else we're not going to get our, here, let's go to our real view here, because we don't have our dynamics. And then without our dynamics, it's much harder to get through this. So we've already gone through this stuff, and now we're going to go through our roadmap. Okay, I wondered why it wasn't moving. There we are, coronavirus update. Now we get to see the data. Otherwise, it's confusing. Here we go. Now that you'll see objects flying into the screen, you'll know what I'm referring to. So again, years are not in scale. 2015 population, 7.2, 4.4 billion, 1.2 for Africa. Notice the color coding on the lines and color coding in the letters. Latin America, 0.6 billion, Europe, 0.7 billion, North America, 0.35, Oceania, 0.04 billion. Here we go. Same data, same color code. 2015 growth. So Africa was growing 2.3%. Oh, I'm going to need water. Check my monitor. Not working yet. I will check it until I get it going. This will pay off. This will give me great comfort that that you are seeing me. Okay. Africa, 3%. Oceania, 1.5%. So notice, Africa, which is such a rough, tough place to survive, right? it's impressive that they're growing the fastest. Oof, that might not be good, but they're thriving. That's amazing. I did not expect that. Okay. The world is growing at about 2%, 1.1% for Latin America in 2015. Probably similar now to what it was in 2015. Asia, 1%. North America, less than 1%. Europe, a tenth of 1% growth. And here we go. I've got some letters appearing. You see them down at the bottom there? Spain brings smallpox to Mexico and South America. They really got there in 1500, and the impact was felt by 1600. In those next 100 years, the population collapsed. More than 80% of the indigenous population of North and South America, especially the Latin America area, was really manslaughtered because the Spaniards got to Latin America long before the British really started settling what we call the United States now. Okay, then we had a near extermination. This is when the orange line starts, when America's population comes on the chart, and the North Amerindian near extermination. I don't know what the population, what the percentage of loss was of population, but we see in the chart the orange line going down. And then we see it going up because Europe came into North America. Then we had the Great Depression, and that really, that and other things brought down the population. World War I and II really hit Europe hard. The pill probably caused some loss of population in North America and Europe at a period when the economies were booming. AIDS probably beat up on Africa quite badly. Okay, that's a perspective for how we've been thriving. We're going into coronavirus. We're still growing as a population at 2% in the world. Europe, not much. In North America, somewhat. It'll be interesting for people to look at this and see, did coronavirus have enough impact? I think it's not going to. It's not going to have the biblical level of impact. So I pray, and so I hope. Here we go. This is a chart I've been presenting. This one's updated till today. World wars. Reading the title, World Wars, Epidemics, Pandemics, and Plagues since 429 BC. And looking at the columns, I have a time period during which each of these events occurred and what the world population was during that time on average. The deaths and how many people died, right? For example, 1 in 6 people died from the Black Plague, right? And going down to coronavirus at the bottom of the table, at the top is Black Plague of the 1300s. At the bottom is coronavirus, 1 in 100,000 humans have died so far. We hope it won't get much worse. And then next column says how long it lasted. Notice AIDS has been around really for 100 years. I thought AIDS started in the 70s, but it started in the 20s. All right, and deaths per year. Who had the most deaths per year? The influenza after World War I. 50 million people died. Whew, over 2 years. 50 million per year, 100 million deaths. Incredible. If coronavirus acceleration continues, it could compare, but it would have to continue for some time. It could compare with some of these other biblical events, I'm calling them. But we have an opportunity to evade a biblical event, right? There's a little bit of good news from New York. It tapered a little. 1 or 2 days. So we hope, so we pray. Cross your fingers. Cross your heart. Whatever works for you. Or just send out a positive energy. And maybe we can escape too much devastation. For the whole world, total cases 1.3 million, 74,000 deaths as of 2 o'clock today Pacific. 1.3 million cases, there it is. 74,000 deaths. So the rate is still increasing a lot at the world level. Look at the charts. It's not looking like New York tapering off at all because it's hitting the whole world. So it looks like we will not be able to avoid 1.5 million deaths, cases, 100,000 deaths. There doesn't seem to be any way to avoid that. 4,700 deaths in the past 24 hours says 200,000 deaths by April 16. If this pace continued, if the rate of growth over the last 24 hours continued. And in the United States of America, 362,000 cases, 10,700 deaths. Same thing, 2 o'clock p.m. So there are our total cases. 24 hours worth on the website I checked was 1,100. That's an 11% increase, which says by April 27 we would have 100,000 deaths in the United States. Let's look at that. 200,000 deaths for the whole world. That would be April 16. Let me see if this is consistent. By April 27, 100,000 deaths in the United States. Those two statistics are not inconsistent. For example, I don't have more deaths in the U.S. than in the world. That would not be consistent. So that was a good check. Okay, where are we by country? Let's look at this. The red Red stuff is bad news. So the U.S. is bad news because we're at the top with the most cases, but we're not the worst news in terms of deaths. That would be Spain right now, who passed Italy. Wow. I should have made that a red letter. I mean, a red number. 40,000, oh, excuse me, 13,000 deaths. Oh, wrong column. Pardon me, this is still Italy. I was looking at the recovered column. 16,000 deaths in Italy. They're third in terms of cases, first in terms of death. 12.5% deaths per case. Ouch. Then the good news, Germany, 1.7% deaths per case. Look at that column. So, yeah, let's look at our bullet points here. This was as of 2 p.m. And here's our bar chart of the same data. So I've got a few notes in here, but let's look at the bars first. This gives us proportion. The United States has the most cases, and Spain has second. There we go. The red is death, the color of death, sadly, on this chart to highlight that tragedy that has befallen us. I think we can see red on every chart, on every country, excuse me, in this chart now for the first time, whereas before I put the chart up, in many countries you could see no red because the number of deaths was too few to register. But now we're seeing red on every country, I'm sad to say. We have the most cases. Why? Well, we have the most international travel. We did have a slow response. We have a lack of emergency preparation. We don't really have, we have a federal government that is continually stating it prefers to let the states handle it at their level. A lot of people feel like that's, including many leaders like Governor Andrew Cuomo, feel like that's not going to be it has not been, is not, and won't be the most effective way to coordinate and fight the battle. I will say I am surprised. I think that I'm nowhere near the only person surprised that the Trump administration, and specifically President Trump, has decided to be so hands-off. They're involved. They're getting people ventilators. They're working with corporations. They're getting ventilators made. They have put in place social distancing guidelines. They've done some things. They've done a lot of things. How much more could they do? They're the federal government. They have so much more in terms of revenue and resources than the states have. There's just no comparison. And so it makes sense that because they're the central organization, they have the power, even of a law that gets to where the president can invoke a sort of a wartime power, that he has managed it in an interesting way, right? He has invoked that power, but not used it. It's interesting. That's like a cop stopping you and saying I have the right to arrest you, but then not arresting you. So something sort of like that. Anyway, so we don't have that centralized leadership. Asset allocation probably could be efficient if it were centralized. Coordination, right, among the private sector and states, not happening. All right. And data collection, there's no master website that I know of that the federal government has created where they've given us wouldn't it be great if they had all the statistics in the world that are available so that all professionals around the world could collect this data, right? We have the resources. We have Bloomberg. Bloomberg is a company that could do this. Greatest data management company you could ever imagine. Most of us don't touch Bloomberg. I lived on Bloomberg 24 hours a day for 20 some years. When you work on Wall Street, that's just part of life. Bloomberg is an attachment. It's like your third hand. I'm not exaggerating. And Bloomberg could have done it, but anyway, they're not doing it. Okay, because I thought people were thinking about like Google doing it. Yes, they're powerful and they can do it. Trust me, Bloomberg could easily do it best of anybody. Then they could just hook it to Google. Google could just give us access to Bloomberg. That would be the way to handle that, because Bloomberg's not set up for all of us to see it online. It's set up for you to pay for a workstation, expensive, $1,500-$1,600 a month for each workstation. But in this emergency, Bloomberg could have done everything for us. They have all the tools, all the talent. Okay, lack social separation in the United States. All right, we do have a glimmer of hope. Green is good news. China has the most recoveries, and they're maybe doing better now. I heard that China, I saw a photograph of several thousand Chinese, maybe 5,000 or 10,000 Chinese in line at what do we call it? An entertainment park? What do we call it? A fun park? Can't remember, think of the word. Amusement park. And they were all right up against each other wearing their masks today. So what will happen in China? Brace yourself. Hold on. I don't know. Germany, Israel, Russia, Australia, they have low deaths per case. Very impressive. We can see that in the chart. Okay. Coronavirus opportunity. Could this be a new golden age where we improve emergency preparedness and we become aware of the fragility of life and we cherish every breath? Will we become more resilient? Will we connect with each other from the local level, from the individual level? Are you getting along better with your friends and family now? Connecting with them more, talking to them more, emailing more, texting more, FaceTiming more? Will we cooperate better with each other? Will we think more communally, not commune? I'm a hardcore capitalist. I believe capitalism is the greatest thing. There's a perfect? No, 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 no. Not even close to perfect. Why? Because we are not even close to perfect. We are human beings. If we were perfect, would we not be boring? I wish we were a lot more perfect, but not perfectly perfect. Because wouldn't we be more boring? Wouldn't we be? Would there be no point in even almost living if everything were perfect? We were all perfect. Would there even be emotion if we were perfect? Ooh, would we live in that kind of state? Just an angel state? I don't know. All right, education, science, and technology. How much will their importance in our culture increase? It already is important to mankind. We certainly invest resources, but maybe we'll greatly increase our focus on that, especially our younger generation. Okay, here we go. Now what's next? Market update. Okay, we've been doing those. This is big. This is huge. Let's look at what's going on. Red bars. Okay, this is, by the way, S&P 500 index. Let's look at this title. End of last year to today. There's the line. Okay, blue line on top, bars on the bottom, red bars on down days, green bars on up days. Why do we care? Because if you see more volume on down days, that means there's more sentiment, more people pushing, more negativity. If you see more bars on up days, more volume on up days, then there's more people thinking more optimistically. And well, you're not going to be surprised that they're usually in this period since the 19th of February, right there since the all-time high, where there are there's more volume on red days, on down days than on up days. Now, there's been a recovery too, so let's see how bad it gotten and where we are. We went down 32% on March 20, and I will tell you, I never expected it to come back as it has. No way. We're back up to only 21% down from the high. Okay. And that is not necessarily good news. And you're going to see why here. Same chart. S&P 500. Now let's look at the S&P 500 going back further. 75 to now. Okay. This chart says February 76. So really, it's from early 76. So here we go. Here, let's fix it. What the heck? Feb 2nd. 76. We don't like the way that looks. All right, now it looks correct. This is our presentation in which we take great pride, right? Okay. Now here we go. Black Monday. The market broke the record, dropping 21% in one day. That was the one-day record. Okay, one-day record. From March 2000 to October 2002, that's about a year and a half, a little more, right? October. March 2001 would be 1 year. March 2002 would be 2 years. Oh, it's well be over 2 years. So 2.5 years. Anyway, came down 49%. Nearly half of the market value was lost. And look, more than half was lost. By the way, that was the internet stock bubble, right? Bursting. Financial crisis of 07-08 took away 57% over a shorter period. Wow. Okay. So now we're down 21% from the high on Feb 19. Now notice, in each case, I have looked at where the drop came from a peak to a trough. Okay. All right. And so the average price earnings ratio, there is a price. The average price of a stock, historically, divided by how much that stock earned in the past year, has been 17 times. So if a stock earned $1 in the past year, it was cost $17. Right. And by earning $1, this means company earnings on their income statement. You're going to see an income statement today, possibly for the first time in your life. Wouldn't that be cool? Won't that be cool? Okay, here we go. Is that sustainable then? Yes. On Feb 19, I came on this show, or right around that date, or just shortly after, and I said that is not sustainable. 25 times price earnings ratio. Okay. I went through a lot of detailed work. I spent a whole show talking about the implied growth in earnings. And the implied growth in earnings, real growth after inflation, at 17 times is 2% earnings growth. And to be clear, this is gains on investing in the stock. Okay, real growth, 2% forever. That's implied by the price earnings ratio. But when you get up to 25 times, it implies twice as much real growth. That's growth after inflation. Okay, real growth. And that's not sustainable. And I kept, blowing that horn. And then now we're at 20 times. Possibly sustainable, but probably not. Okay? Because that's 3% real growth. That's still a lot more than 2% real growth. Right? And with coronavirus, that does not look sustainable to me. So the investing implications are still, even though we are way down, we're down 20% from where we were. It's interesting. That first show I talked about a 20% drop. The market was worth 40 trillion that day, and I pointed out that would be an $8 trillion loss. Okay, so we're there. We're about $8 trillion down. But to me, that would have been more like a normal level where we should be. Well, that's where we are in the midst of coronavirus. So to me, there's a lot of risk. If you're risk neutral, sell some stocks, sell long-term bonds, especially. They've already rallied. Long-term government bonds have rallied like crazy. But can they rally anymore? They maybe some more, but sell them. If you're really going to play it safe, sell risky bonds, buy short-term bonds. And if you're very risk averse, sell stocks and bonds, buy certificates of deposit sold to you by your bank or buy them online. I found some just before the crisis at 2%. They're called Marcus Goldman. They deserve an advertisement since they were paying the best rate in the world that I found. And you re-enter the market. Back to this. If you're a risk-averse investor, re-enter the market when the end of the crisis is in sight. This is how the market normally has looked, right? And let's look at the middle item in this chart. I've pushed this one open in front of you many times. The average individual stock makes 12%. Green bars are return. Red bars are risk. Risk is volatility, and average individual stock returns have been around 12%, more like 10% historically. I took this from a certain period, and I don't remember the exact period. I should have written that down. But the point is, keep in mind, you make about 10% investing in stock, but that volatility of 40% means this. Add 40% to 10%, you get 50%. Subtract 40% from 10%, you get negative 30%. So 2 out of 3 times the market is between negative 30 and 50. That is an extraordinarily wide range. So individual stock investing is extremely risky. All right. And then 1 out of 6 times you do worse than negative 40% or negative 30%. Let me see. Yeah. And 1 out of 6 times you do better than positive 50%. But that's a huge range. You can still make 12% without that huge swing, those huge swings, by buying a diversified portfolio. You can get into a diversified portfolio by buying ETFs or mutual funds that imitate the S&P 500 index. And look, next to the middle bar is the S&P 500 index, and it has the same average return as the average stock, but the risk is massively lower, 16%, because you're diversified now. The real risk is in the market's more like 20. So think of the market as being something where the middle return, average return on stocks, please remember this for the rest of your life, is 10%. And how risky is it? Well, because this volatility, we call it volatility, is 20%. You take your 10% in the middle and add 20, and you get 30%. That means, and wait a minute, one step at a time. Add 20 and you get 30%. Subtract 20 and you get negative 10%. So between negative 10% and 30%, 2 out of 3 years, that's where your return will be, in that wide range. Still a wide range, but vastly less risky than an individual stock. 1 out of 6 times you'll be outside that range, better or worse. Okay? I won't get into more detail on this. If you want to learn more about this, hey, contact me. I'm easy to find. Okay? Buying a restaurant versus buying a stock. Why would I do that? I mentioned in the opening because some people might wonder, what is the deal? Why is there so much money invested in stock? Why is the market worth 30, 40 trillion dollars in the US, 60 trillion in the rest of the world, 100 trillion worldwide? Well, you're going to buy a restaurant and your minimum investment is going to be something like 100 grand or more, right? That you're going to need. Either you're going to put some money in there and the bank's going to give you, or you're going to put in at least 100,000. You want to put up a really nice restaurant, you're going to put in way more than 100 grand, right? To get the restaurant equipment and get the place, or get into a big lease to get the place. All right. Okay. Whereas you can buy stock, you can open an account now with no minimum investment. So, by the time you get $100 or $200, $300, I know a bunch of students now, a nephew of mine, they only have a few $100 and they have an app. They're investing on their app because they know there's no minimum balance. They just went on there, got the app, and started investing, which is spectacular. How many years will you prepare if you're going to buy a restaurant? Probably years. You're probably somebody who's been in the business, or you're going to go in business with someone who knows the business. You're not crazy. You're not going to go into a restaurant and invest hundreds of thousands of dollars, and you've never done it before, and you don't have somebody helping you who's done it before. Your manager or your partner. How long does it take to buy stock? A few seconds? How long will you negotiate in all the things you're going to acquire to get that restaurant, including maybe buying a building or buying equipment? Months? How long does it take to negotiate buying a stock? A second? How long will it take you to get your financing for a restaurant? Months? If you're buying stock, right? That the financing thing is not a consideration at the moment, at the point where you're buying the stock. It can be if you're doing margin trading, and you can look at my older shows if you want to know what that is. It's borrowing money to invest in stock. But even then, your account is already set up to do that, so you don't spend any time. All right. Isn't that fantastic? Your online investing account has a margin account automatically attached to it. You can go in there and buy stock on margin. They will lend you the money to buy the stock, and your cash will remain in your account. And then when you sell the stock, you'll pay back the margin. All right, time you spend administering, and you'll pay interest on that margin. How many hours a year will you work on your restaurant, and how much time will you spend administering buying stock? Not much. Now, if you're a pretty serious investor, a day trader, and you're working trading, well, then you will put in time. And if you're really serious and you're putting in full time, into investing, then you're putting in your 2,000-3,000 hours a year. But if you're the everyday person who goes in there, buys some stocks and doesn't think about it anymore, then yeah, it's zero. What is the management level, skill level? If you buy a restaurant, it's you. But if you buy a stock, you get the best trained people in the world in these big corporations running them, right? How fast can you get rid of a restaurant if you need to? And how fast can you sell a share of stock? So it'd take you months to sell a restaurant, 1 second to sell a share of stock. Okay, that's it. All right, we've been going a long time now. Whoa, time flies. What is a share of stock? Okay, it's not a loan. You own the company. It's a perpetuity. It's something you own forever. It's proportional. You own the shares you own are the same as everyone else's, right? And you can sell it whenever you wish. It's easy to buy and sell at a fair price. You have a right to vote when you own stock. You get represented by the board of directors. That's their job. So a board of directors represents shareholders. They represent the owners, right? I have a tickle. Excuse me. In my throat. Okay. Convenient access to all the legally required information. If you own a stock, right to dividends, right to gains in value. If you buy the stock and it gains value, you're legally protected by the government against insider trading, market manipulation, blah, 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 fraud. Red is the bad news. You are the lowest on the totem pole when you own a share of stock. In other words, the company will pay its taxes first, its employees, its vendors, and its creditors before it pays you. It pays everybody except you, and then when they're all paid off, then you get some money if they decide to pay dividends. You risk that the price will decline on the stock. You do have agency risk, it's called. And that is maybe your management team are incompetent, they're not diligent, or they commit fraud. You do run that risk when you invest. That risk is extremely minimal nowadays when you're buying stocks on the stock exchange because of all the things companies go through to just get issued, to get created. And you'll see some of that, some sites coming up. And you can sometimes have the market itself failing, and that can hurt you. From the issuer's perspective, what's so great about stock? There's great prestige in being somebody who issues stock when you found a company. You'll see why. You get a lot of money when you issue stock if you reach that point. If you reach that point, you already have probably got some money, or you may be very in debt. But the moment you go public, you've got a lot of money in your pocket. And you should, because if you achieve that, you deserve to have money in your pocket. Again, for the company, hey, it's perpetual capital. They don't have to repay it. And you never even have to pay dividends. Your profits, you can keep all the profits. There are many companies that don't pay a dividend. All the gains you get as a shareholder are the gains from the stock increasing in value, especially younger companies that don't have cash. They have a scarcity of cash. They borrow money and they're consuming cash. Even though revenues may be growing, their costs are growing faster than their revenues because they're spending it on building up the business. But yeah, once you have stock issued, then you can borrow a lot more money hugely more money when you're a publicly traded company than if you're not. Um, your price communicates a lot of information about your value, your performance, your competitiveness. It's a great tool to pay your employees with, pay with stock. Fantastic tool for that. You can use it as a currency in an acquisition. You can buy a company just by handing people from the company stock, your stock. They'll take your stock and they'll hand you their company, right? Okay. What is the negative aspect of being a stock issuer? That you share power and profits now. You're not the only owner. If there was one owner for a small partnership, they have thousands of partners. Now you can structure the IPO so you retain more than 50% control, but most people don't. Most people end up with some 10, 15, 20% of the stock in the hands of management, especially the main person, and the rest goes to other people. Now that board of directors has an amazing amount of power. So you're now accountable to shareholders through the board of directors, and that's not fun, trust me. And you have to have fantastic accounting, reporting, and you have to follow regulations, which is a humongous burden for public companies compared with private. You lose an amazing amount of power to shareholders, I just said it, and board of directors, because they can vote, and you are now under immense public and government scrutiny. Now the press will get all over you. Why? Because you're handing your laundry out to dry in public. You're reporting all your results, financial results, publicly now if you issue stock. If you don't issue stock, you don't have to give your financial information to anybody that you don't want to. You maybe just give it to your top managers of your company and any partners in the business. And even the employees of the business may know only very little about what the true numbers are underneath the company. The biggest risk you take when you issue stock is that some other company will come buy your shares and control you, and it happens. Used to happen a lot in the 70s and 80s. That's one of the reasons I got into investment banking, because that caught my attention. I fancied myself buying Inland Steel, the company that used to employ my dad. But that never happened, but I thought that could happen, and I was considering doing it because I knew that business somewhat. I had worked there during summers, and I could see many ways it could be improved. That was my theory. All right, anyway, preferred stock is a type of stock that has priority over common stock. And if you know what stock is, you should know it. There is no such thing as should, but it is a great thing to know what preferred stock is. If you hear the expression, all it means is that whoever owns preferred stock, when they bought the stock, they were told, you now own preferred stock. We designated it as such, and you have priority in your dividends. And this is actually how much we will pay you in dividends. So preferred stock has an amount of dividend that will be paid right on it. No common stock has that. So we distinguish preferred from the other stock as preferred versus common. All right. So preferred stock sometimes has more voting power. Even common stock can have more voting power than preferred. And remember, the issuer, the company that sold the stock, doesn't have to pay dividends, not preferred or common dividends. They don't have to pay them. However, preferred, that means preferred dividends can get behind. They can go in arrears forever, and no one gets arrested. By then, a company's probably not doing very well, losing money. People are getting fired. Companies going bankrupt if it's not paying its preferred dividends, but it's not illegal. All right. However, here is the thing. Preferred dividends, I said it earlier, I didn't put it in here, are set. You know how much you're going to get, which makes them behave a lot like a bond, including their price behaves a lot like a bond. But secondly, preferred dividends have to get all caught up. So if they're in arrears, if they're behind, they have to all be caught up before the issuer can pay common dividends to the other shareholders. Normally, when we say stock, we mean common stock. We don't sit around going common stock to distinguish from preferred. If we say stock, we mean common stock. Here's some dates to know about dividends. As a part of the trick here is, and you can just go to sleep for a second on this because I'm going really fast through this, but it's a detail that it's great for you to know. When you buy shares, you really don't own them until 2 days later. So that means you don't own the dividends that were paid unless you owned them on the ownership date. You'll see what that means. There are 4 dividend dates. Okay, here's our example. On the announcement date, date 1, say January 20, company announces they're going to pay $1 per share on February 1st. Notice, on February 1st, right? Not the next day, it's a few weeks ahead. But the owners are as of January 20th. So 10 days after they announce, if you own the shares, you'll get those dividends, but you'll get them on February 1st. Right? So that's one date. The ex-dividend date, in this case, is January 19th. Here's why. Because of T+2. If you buy them on January 19, you don't own them until January 21. But when they announced it, they said owners as of Jan 20 would get dividends. So I got to be careful with my dyslexia when I do this. So yeah, so owners as of Jan 20 bought the shares either on January 18th or before. I did it right. I think I did that right. Okay. So anyway, that's the second date, is the ex-dividend date. By the way, on that date, in theory, the price of shares should fall, and they do. They do tend to fall a little bit relative to all other dates for all of the shares. Studies have been made, and they do fall by the amount, not quite by the amount of the dividend, but by an amount nearly as much as the dividend. The record date is that January 20 date, the date of record. That dictates who gets the dividends. Payment date, February 1. So those are the 4 dates, and they happen every quarter for most companies that pay dividends. I'm going to say every company I know of in the U.S. pays dividends every quarter, once every 3 months. All right, 4 out of 10 companies pay dividends. The dividend payout ratio is called dividends over earnings, and the S&P 500 dividend payout ratio, and I think this is average, is 30%. That means those who pay dividends pay more, but 30% of earnings get paid out. The rest of the money is kept by the company to keep the company running, which is fine. It's absolutely fine. Okay, dividend yield is dividend over stock price, and dividend yield S&P 500 is around 2%. So that means, given that the average return is around 10%, remember that number, 10%, hammer it into your brain, tattoo it on your arm or something, mark it on a marker, wash it off, so you'll never forget. The average return of the S&P 500, 10%. Okay, but wait a minute, 2% of that is dividend yield, dividends, because return includes dividends. So that means gain in value is 8% per year. Most dividends get paid again once every quarter. I think I said that twice now. Have you ever seen financial statements before, like real ones, where you're about to? They're not real ones. These are not the real financial statements of Apple. Would be those financial statements you look at in their annual report online, or if you had their annual report in your hand. Okay. However, all the numbers from their recent financial statements are about to be in front of you on a spreadsheet I created, and I just copy pasted it from the internet, from Yahoo. All right, here we go. Here are things to know. Public U.S. companies are required. Public means they issued stock that's publicly traded. Okay. Public U.S. companies are required to submit 3 quarterly reports. They're called 10Qs, Qs for quarterly, and an annual report called the 10K. I don't know why they didn't call it the 10Y. Maybe the 10Y was already used for something else. It's called a 10K. So every year, 3 quarterly reports and 1 annual report. Most companies do that at the end of the year. They do the annual report comes out in late January, early February, mid-February. Companies are getting quicker at that. They used to take longer to get to print, and so they come out at the beginning of the year. Okay, most companies. But you don't have to. You get to tell the government you're going to do your quarterlies and annuals in equal quarterly periods throughout the year, but you get to choose that. A few companies are off cycle, I'll call it. And maybe that's better, because maybe then when they're reporting earnings, they're not in the crowd. People get to pay more attention to them. I would say a company that's more complex, more unique, might benefit from doing that, right? Okay. Because maybe they have a longer story to tell. There's more there. All right, 10Qs and 10Ks are huge. A 10Q is the brief version. It gets a lot less auditing. It's 20 pages long. 10Ks are over 100 pages long, 200 pages long, and they get audited by auditors. I didn't put that in here, but that's very important. What is the information in there? Look at this later. It's anything and everything. Everything that the government says is relevant, plus anything the company thinks they would like you to know, including every risk they're taking, is in these forms. So they are humongous. Okay? Here we go. The most referenced information in quarterly reports by far is financial statements. These financial statements come in 4 flavors: the income statement, the balance sheet, cash flow statement, changes in shareholders' equity. Which one tastes best? Cash flow statement is the most important, but most investors actually don't look at that much. But when you're valuing companies, that's the most important statement, and the balance sheet. I'll explain why. Accountants have the awesome responsibility of keeping the books, which really means they create the financial statements. So they track all the accounts. And if you ever heard the word account, every account in a company, ultimately its purpose is so that it could become part of the financial statements that describe all of the financial, so to the last penny. Trust me when I tell you, to the last penny. Every penny that comes in a company, that goes out of the company, ends up in those books. Now, how accurate are the books? Within 1 or 2%. Over time, there are lots of estimates that management has to use to save time. And so you get a little bit of noise in there, you get a little bit of inaccuracy, but they're accurate. They're great. Accountants are amazing, and they do a great job, mostly, 99% of the time. Not always, but mostly. Wall Streeters, that would be traders, underwriters, mergers and acquisitions, Wall Streeters, in other words, investment bankers. Dismiss accountants as bean counters, but accountants, in a way, have the upper hand in one regard. They have a higher ethical reputation than anybody, including investment bankers. So accountants are really, it's a great profession. It's a hardworking profession, not for everyone, but for the right kind of personality. If you are a really diligent, serious personality, and you don't need $1 million a year to be a happy human being, you're a balanced human. I think accountants is very practical, balanced human beings, very reliable. I'm going to take a wild guess. Accountants get divorced way less than other people. I'm going to look that up. I would not be surprised if they get divorced half, a fourth, a tenth of everyone else. I've been around hundreds of accountants throughout my profession, and couldn't hold them in higher esteem. Fantastic community professionals. All right, let's have a look at Apple's income statements. Is Apple not one of the most fascinating companies in the world with their iPhone and Jobs and all the whole story? Here are their financial statements pulled right off of Yahoo. Don't worry, we're not going to look at all these numbers. No way too many numbers for this show. But we'll highlight this. It has a nice level of detail of where the revenues are, that's the money coming in, what the profits are, then the money going out are costs like research and development. Go down the line here a little bit. Selling expenses, general expenses, administrative expenses. And you add those, you get operating expenses. And you end up with your operating income. But then from there, you subtract interest expense, other kinds of miscellaneous expenses, including interest income. So here we have negative expense. So interest expense is 4 in 2019, and the number underneath it is -5 on that side on your screen. And that means they had negative expense. That means they made 5. And that's probably interest income or income from investing that goes there. Okay, so their income before tax for Apple in 2019, 66 billion. These are billions of dollars. Yeah, I do have that. Billions of dollars. Yeah, I do have that. Net income, $55 billion. That is an amazing achievement. Okay, the revenue is 260 billion. And they turn that into 55 billion. So about $1 in $5 they receive, they turn that into profit. $4 in $5 they spend on all their expenses. That is a fantastic ratio of income to revenue, better than the vast majority of companies. So here it is. Income statement records all revenues and costs. That's how you calculate income. But the income statement has a lot of rules. Okay? And what they're trying to do is not capture when money comes and goes, believe it or not. Okay? Don't let this confuse you. Don't cross your eyes. Hang with me. It's not exactly when money comes and goes out of a company that dictates how profitable it is. Profit is how much value a company is really making for an economy, and you'll get it. I'll give you a couple of quick examples. So there are rules that are called accrual rules. And what these rules really do is, instead of just looking at when cash moves, look at when the company actually takes legally, I would call verifiable actions, whether it's a sale or a payment, and that at that point, that company really is committed, or really has a commitment from another company that something will happen. So revenue is recorded when there's a real commitment for both sides that revenue really happened, not necessarily when it got paid. Because you could sell something on credit, but you get credit for revenue if you hand somebody a car and they agree to pay you. Then you've earned revenue. Here's an example, though. Let's say you bought raw materials. Let's look at the cost side, not the revenue side. You buy coal. Guess what? That's not a cost. It doesn't hit the income statement. When you buy coal, what you do is you record on the balance sheet, which is next. We don't have it up yet. You record on the balance sheet that you no longer have cash. You take it off the balance sheet, and you put coal on the balance sheet. Because you haven't done anything economically. You have not added value when you bought coal. And you've not taken the value away from the economy. All you've done is position yourself to do your business. Okay? Then when the coal gets consumed, as the coal piles go down, okay, then you record it as being consumed. And so as you're making sales, let's say you're making electricity for the coal and you're consuming the coal to make electricity, then the coal that gets used to make that electricity that creates the revenue, that's when it gets expensed. So accountants are fantastic at tracking when does the coal come in. Literally, they keep track of all of that. And how much coal gets used to make electricity, so that we can decide when we sell the electricity how much coal to expense. They do a fantastic job at that, let me tell you. If you're not used to doing it, people take accounting courses and they quit. They don't even finish business school because there are so many accounting rules. But if you get through it, once you learn this accrual thing, it becomes really second nature. And the best thing about it is it makes sense. Then you get good at it. You get good at it, like riding a bike. At first, man, you can't ride that thing, and a week later, you are just zooming along. All right. Another example, if you borrow money, you get cash, but that's not a revenue. You didn't sell anything. If you're in business to sell, you didn't make a penny when you borrowed money. All you did was you took in some cash and you took on a liability. Those, again, go in the balance sheet. Okay? You get rid of some cash and you take on a liability. By the way, those are in balance with each other. The cash that comes in, the liability that gets created. That's why it's called a balance sheet. Now, the interest expense on the borrowing, that is a cost. That'll hit the income statement. We see interest expense right here. Okay. But when the debt gets paid off, same thing. Cash goes out the door. The debt gets wiped out. So those get wiped out. Here we go. Income statement analysis real quickly. So these are the same. This is the same data. And let's look at this. The green line, look at the legend on the bottom. The green line is revenue, and the blue line is gross profit. The light blue line is income, operating income, and then the orange line is income before tax. Normally the orange line's below this one, but they handle that income from investing. So their income before tax is actually higher than operating income. That's unusual, but hey, that's to their credit. They have a lot of cash. They make money with that cash. Anyway, so these are the costs that bring you down from revenue to gross profit. Is labor, materials, factory costs, like the electricity in a factory. The accountants keep track of it, and they attach it, make it a cost. Okay, and the non-operating costs like research, selling costs, management salaries, interest expense, those get subtracted. Then you get to operating income, and then you get income before tax. Normally it's negative here. Normally there's a positive cost there, but anyway, you get income before tax. And then the difference between the orange line and the red line is taxes. So here we go. Apple's revenue and earnings grew slightly in 2017. This is an analysis now. We made a chart out of that data from that table. Instead of looking at all those numbers, isn't it way easier to look at these lines to see what's improving? And here we could have seen if one of these lines got really herky-jerky, you could say to yourself, why are salaries going way up? See, we don't have that. It's very smooth and consistent. So here we go. Costs rise and fall in tandem with earnings. Taxes are 15% of pre-tax income. Notice that. And taxes are only 4% of revenue, not high. And that's true for corporations. Taxes on pre-tax income are in the range you might expect, but taxes on revenue are low. So companies have a lot of other costs that are way more major than taxes. Okay. Here's a balance sheet for Apple. Don't worry. This is way too many numbers, right? But here are some things you can look at. If you look at a balance sheet, you do analysis, you look at year to year how the accounts are changing. And these are called accounts. So you have it's what you own and what you owe on a balance sheet and what your net worth is. Okay, on the left side, we have all the assets, what they own. And on the right side, we have what they owe, liabilities. Shareholders' equity is what's left. So if you take assets, subtract liabilities, you get shareholders' equity, probably the most famous equation in all of accounting. Assets minus liabilities equals shareholders' equity. Sometimes shareholders' equity is called stockholders' equity, which it is here. Sometimes it's just called equity. Okay, all the same thing. Here we go. So what do we have? Balance sheet is so named because total assets do balance with liabilities and shareholders' equity. Here's what I mean. Look at the bottom. Look at the assets. The bottom of 2019. Bottom of 2019, the number is, drum roll, $339 billion of assets, which means Apple has a lot of assets, right? $339 billion. How much revenue? $260 billion of revenue on $260 billion of revenue. Okay, so you have to have a lot of assets. Okay, that's what $330 billion assets. So think of it as a business. $330,000 may make you $260,000 of revenue, but then you have $50,000 of profit. Make those billions into thousands. Now imagine you're a business owner. You want to know? You want to have a feeling for what it's like to run a successful business? Look at these financial statements, and this will apply to you. It will apply to you proportionately, amazingly, consistently, right? This is a business, and now you're seeing a lot of fascinating information about the business. When you start looking at the accounts, and the accounts titles may be a little vague, but they're pretty self-explanatory. And what would you do? You would Google it. You would go look at a YouTube video, and you would learn. All right, so here we go. Assets are on the left, liabilities and shareholders' equity on the right. All of this combined is called the balance sheet, both sides. And notice something. At the bottom of 2019, assets are $339. Bottom of 2019 on the right side, liabilities and shareholders' equity on that side for you, $339. Bottom of 2019. They are in balance with each other. If not, there's something wrong. There's a mistake in the accounting, which doesn't happen in professional accounting. Those mistakes happen in classrooms when you're learning accounting. Otherwise, they don't happen. So it's called balance sheet because both sides are balanced. And it tracks what the company owns, what it owes, what its net worth is, and that's stock shareholders' equity, stockholders' equity. So here's the formula. Shareholders' equity equals what you own minus what you owe. There's the formula. Most famous formula in accounting. Net worth is shareholders' equity. Okay, same idea. Shareholders' equity, net worth, equity, all mean the same thing. How do you calculate it? You take assets, you subtract liabilities. Most famous equation in all of accounting. Now you've seen a balance sheet. Let's do one thing relating to shares, stock. Here. By the way, remember something. When you own a share of stock, you own a proportion of all of this. And you owe a proportion of all of this indirectly through your stock. And your net worth is a proportion of all of this when you own a share of stock. So it is relevant to look at financial statements. Okay, book value per share is your shareholders' equity divided by your shares outstanding. And here, 90 billion of shareholders' equity. So near the bottom of 2019 on the right side, just one number above the 339 is $90 billion. And they have $4.6 billion of 4.6 billion shares outstanding. Guess what? That was already on the page in front of us. Let's look. Look at 2019 on the income statement. Look toward the bottom. Basic average shares, billions, 4.6 billion shares. So that was already there. We take that off the income statement. Then they have something they call diluted shares. I won't explain those today. But the number of shares could get diluted. There could be more shares outstanding than what's called basic. Not for today. That gets reported. Anyway, here we go. Now, book value per share, shareholders' equity, 90 billion, divided by 4.6 billion shares is $20 per share. So we're going to see that is far less than market value. In fact, what was the market value of shares Friday? I didn't check Apple today. $240 a share, 12 times 20, right? 12 times 2 is 24, 240. Okay, I have to triple check my math, as you've seen if you've watched episodes. Okay, someone trying to buy Apple would not pay $20 per share. They would pay $240 per share if they were trying to buy this company or just buying shares of stock, right? No one goes to somebody and says, your book value is $20 a share. Here's $20. Give me your company. No, okay, but balance sheet analysis. The most important number off the balance sheet, I must tell you, is debt ratio, meaning how much debt you have divided by how much equity you have. Okay. For example, Apple's, and by the way, that ratio, debt over equity, we're going to look at it in a second, leads to credit rating. And credit ratings are attached to the bonds of a company. And the bond credit ratings will dictate how much interest the company will pay on the bond. Because the lower the credit rating, the more risky the bond, the more interest they have to pay to issue the bond. The higher the credit rating, the less risky the bond, the lower the interest rate the company will need to pay to issue the bond. What is a bond? It's a borrowing. But it's split up into thousands of different bonds. So thousands of people, or maybe hundreds, but thousands of people can lend money to the company instead of going to the banks. Okay. So companies issue bonds typically because they've already tapped out the banks. They've got as much bank credit as they can get, and then they go to the bond market and they issue bonds, which is great because, in fact, the interest rates on bonds are really low. By the time you can issue a bond, you're a really successful company with a really strong credit rating. Okay. So our debt ratios to equity, there are other debt ratios that are called debt ratio. This is the most common one, the most important one. And it's all the debt divided by all the equity. And here, they have their debt split in two. Current debt is debt that you have to pay off within a year. And if you look at the right side, liabilities, current debt's the top item. And then further down, long-term debt is about the sixth line down, 1, 2, 3, 4, 5, 6, seventh line down. And you add long-term debt to current debt. And then you get total debt. And equity is that shareholders' equity number, 90, that we looked at. So here, the total short-term, long-term debt was 108. Divided by 90 is 1.2. 108 divided by 90 is 1.2, which is high. High for AA1 credit rating. That's really high. The highest credit ratings are AAA. This is AA1. Only one fraction of a notch below AAA. Normally, only governments get AAA. But the adjusted debt ratio that I'm creating, and you can adjust all these ratios however you wish, is we will subtract cash from debt. Not the equity, because they have a lot of cash. They have $100 million of cash. So when you subtract cash from debt, you only have 8. Actually, 107. They only have 7. Anyway, so really your debt ratio is only 0.09, incredibly low, and that's why they have a high debt rating. Cash flow statement, okay. Notice something. Remember I said the income statement doesn't track when the cash moves? Okay, I've got to get water. Hang in there if you're watching. Be right back. Okay. So the I mentioned that the income statement doesn't track when cash moves. So that means when we look at income statements and balance sheets, we don't know how the cash moved. So this cash flow statement is essential. Okay. This is way more complex to explain the way it gets created. But the beauty of it is it ends up simplifying your life when you want to understand a company, when you know how to use this. And this is cash flows are created by something called the indirect method, and to organize the information the way it's organized here. But there's also a direct method that companies use to check the cash flow statement to make sure that it's correct. And that direct method is really useful too. But this indirect method is really great for understanding how well the company is being managed and how consistently it's behaving, like all the others. Notice we have 5 years in a row here. That way you can make those charts with lines. You can make those charts with lines for all these. And you can watch each line and really quickly pick up on, whoa, why did inventory go up? Did sales slow down? Or was it good because we needed to have a lot of inventory? Or why did it go down? Maybe we're selling faster, and that's good. Let's try to be efficient. Why invest in inventory if we don't need to? Let's keep it as low as we can. Well-run companies keep the lowest inventory. Here's why they keep inventory. Always enough to satisfy every customer to the extent that they want to keep customers as happy as they may desire. For some companies, that means keep them extremely happy. And yet the lowest you can, so that you don't just gobble up cash, keeping cash in the business. Okay. In the world of fundamental analysis, I'm reading my bullet point here. Okay. Cash flow and balance sheets are the primary focus. Income statements are nowhere near as important when you're analyzing a company, when you're really going to figure out what it's worth. Apple made $65 billion in free cash flow. That's that number way on the bottom. Between 65 and 77 billion. What was it? Well, between 64. I was looking at the wrong line. Oh, in operating cash flow. Anyway, look, this bullet point's slightly off, but if we look at the bottom line, free cash flow really measures and what it does, it takes operating cash flow from above. Operating cash flow is up there somewhere. Where is it? Oh, it's not in here. Okay, so operating cash flow can be calculated from all this information. And then you subtract how much you invested in capital, and you end up with your free cash flow. And that's really a measure of what your company is generating, because operating cash flow contains capital expenditure. So you clean it out. Anyway, so they create a lot of cash. Forget all the other stuff I'm saying now. Apple's cranking out a huge amount of cash, 50 billion, 60 billion, 64 billion a year. That's just fantastic. Their dividends are consistent from year to year. There's a dividends paid line, and they pay about a fourth of their net income. Net income is the top line on this in dividends consistently, and that's a good ratio. It's a very healthy ratio. Healthy company. Okay, look at that. We're getting toward the end. Theoretical stock price. Here we go. What you do is you want to understand. Forget about financial statements for a second. We're just going to think about figuring out what is the stock price for an operating company. It's a price you would pay to get all the future dividends. That's one way of thinking of the stock. If it's not an operating company, if it's a company that's about to go out of business, then you would just take what its assets are worth, subtract what its liabilities are worth, and if you have a positive number, then you've got something worth something. But if you owe more than you own, well, then you're just bankrupt. Your stock is worthless if you own stock. Okay. All right. And here's the beauty too. If you own stock, you'll never pay back more than you paid for the shares, right? Whereas if you own a business, you could end up paying way more than a normal business. I didn't put that on that list. Than what you originally paid for the business. You could pay out way more than you put in. You could lose a lot of money. Say just paying your employees. You run it 2 years, make no money, pay your employees, and you paid out way more than you ever got back. That's it. Does not happen when you buy stock. Okay, so here's what we have. when we're going to think of stock prices, the first thing we learn is something called compounding. On day zero, say you pay $100 to an issuer. They issue a stock for $100, and a year later you sell for $110. You made $10. So if we were just doing some algebra, that means if you took the original amount, multiplied by 1.1, price today times 1.1, that would be the price in a year. I know I'm going fast. So the 1 in 1.1 is paying back the initial investment, right? 1 times 100 is 100. So 1.1 has two pieces. It has the 1, and then it has the 0.1. The 1.1 has two pieces. It has the 1 and 0.1. The 0.1 is your return on that 1, on that $100. That's what that 1.1 means. That 1.1 there. The 1.1 right here. Okay? So let's test it. Let's take 1.1 times our $100 we started out with, and we got $110. What do you know? So our 1.1 is a multiple. Our 1.1 is called a compounding multiple. That's why the word compounding is up here. And the future value of $100 is $110. $110 is a future value of $100. That's the terminology we use when we're compounding. Really important for you to learn, okay? All right, because you're going to learn something even more important. The inverse of compounding is called discounting. Don't be afraid. Hang in there. What if somebody says in 1 year they'll pay you $110 for a stock? For a stock. Just exactly like that stock that behaves just like that other stock. Same company, same story. They're going to pay you $110 for it. What would you pay for that stock? Do you think maybe you have a clue from here? What would you pay today for a stock if they tell you, well, we'll pay you $110 for it in a year? Let's look. Let's see. What will we pay for a stock in the same sort of scenario, same universe? The issuer says, what will you pay? Notice the issuer says they'll pay you in a year. They're not handing you a share and charging you any money. They're just asking you what you'll pay, which is the situation you're in anytime you're trading stock. Right? You don't have to buy the stock. You can just decide on a price you'll pay, and if the market hits that price, you buy it. By the way, that's called a limit order in the market if you're placing orders. Okay. So the issuer says, how much will you pay? And you go, well, let me think about that compounding formula. The price in a year is 1.1 times the price today. If I remember my algebra, I could divide both sides by 1.1, and that would leave price today alone. If I remember my algebra, what happens if I divide price in a year by 1.1? I get price in a year divided by 1.1. What happens if I divide the right side? So that was the left side, right side of the equation. What if I take 1.1 times the price today, but then I divide it by 1.1? Well, if I multiply the price by 1.1, and I also divide it by 1.1, multiplying and dividing are the exact inverse of each other, right? If you multiply 3 times 2, you get 6, but then if you divide it by 2, you get 3 again, okay? Multiplying and dividing are the exact function inverse, all right? Back to basic math. Well, let's take that $110 they said they'll give me in a year divided by 1.1. What do you know? I don't believe it. No way. It's a miracle. It's $100 again. We're back to $100. So $100 is the present value of $110. $110 is the future value of $100 in this scenario. And $100 is the present value of $110. So now you learned compounding and discounting. Big takeaway, compounding and discounting are inverse functions, but that means they're the same function. Just like multiplying and dividing are really the same function. All right. Now let's discount some dividends. Okay. So throw that out, clean your chalkboard, your whiteboard. Now somebody says they're going to just pay you dividends. And here we go. On day zero, the issuer doesn't talk to you about anything other than one thing. Hey, I'm going to pay you $10 of dividends every year for 100 years. Now you're going, ooh, what happened to that $100 thing? $10. Oh, man, I'm lost. What am I going to do? I'm nervous. What did I do last time? They said they would give me some money. They said, well, we'll give you $110 in a year. What did I do to that? I divided it by 1.1. They said you'd give me $110 in a year. I divided it by 1.1. Would that work here? They're telling me they give me $10 every year. Every year. Well, let me just look at the next year. How much am I going to pay these guys? Let me start doing some math here. Let me sit down and sharpen my pencil. In a year, I get $10. But if I divide that by 1.1, that's only $9.09. Well, I'm only paying these guys $9.09 if they only gave me that $10. But they said they'd give me $10 every year. What about the second year? Let me move forward in time 1 year first. I'm no dummy here. Next year, when I get that first one, I'll be looking forward to that next one, and I'll go, I can divide that one by 1.1, and I'll get $10. I'll get $9.09 next year if I look at that second year, right? That second payment. However, that $9.09 that's $9.09 a year from today. So I've got to divide that, the 10 divided by 1.1, once more by 1.1. So that means when you discount for 1 year, you divide by 1.1 once. But when you discount for 2 years, we're getting good at this. We whip out our spreadsheet and we divide, or we get our calculator, 10 divided by 1.1 divided by 1.1. We get 826. And we do that for all the years. Oh, and I'm sorry, I had said they would pay every year, but I lied. The issuer says they'll pay you for 100 years. So you're only going to do this 100 times, and on a spreadsheet, you can do it fast. Trust me. So you do it on present value for year 50. I'm jumping way ahead. That was year 2. That's worth 826. That year 2 payment. That's worth 826. By the time you get to year 50, man, they're not worth much. But they're worth something. The year 50 payment today is worth 8 cents. Present value of $10 50 years from now. So the future value is $10. Present value is 8 cents. And if I do the 100th payment, it's worth way, way less than a penny. And when I add them all up, I get almost $100. This $100 thing keeps coming up. We keep coming up with $100 today. Well, there is a formula that gets used for a perpetuity. That means somebody really does say, hey, we're going to pay you that dividend every year forever, $10 a year. The present value of a perpetuity is the yearly payment divided by the return rate. So our return rate was 10%. Let's get back to that number. 0.1, that's 10%. That's our return rate. Okay, that was example 1. Okay, here we go. So when it turns out, I'll throw we won't do the algebra here. Okay, we won't do the algebra here, but there's a way that's clever where you know all these guys. There's a way to do this algebraically and then get rid of a bunch of them. Just get rid of all this garbage and you end up with this thing. You just grab the perpetuity and divide it by the rate. And what do you get? Unbelievable, $100. $10 divided by 10% is $100. Okay? All right? I've kept it simple by sticking to 10%. And also, I've kept it memorable because that's what the average stock happens to make. So it's great for you to have that proportion in your head. All right? Here's an example, though, of something beautiful. Now we're going to combine that discounting with our financial statement knowledge that we've now gained. Remember that free cash flow number? The free cash flow is, in the end, all the money that this company is cranking out. And you divide it by, instead of dividing by just the rate here, see, we just divided by the yearly payment divided by the return rate. We have another little twist. That's the growth rate. Okay. So we take the free cash flow, and instead of just dividing by the discount rate, just an R, we subtract from R the growth rate. That makes this bottom of the fraction smaller, and it makes the number bigger. The whole number together bigger. Don't worry if you're not good at fractions. Don't worry if that's confusing. Don't worry. Just hang in there because we're going to get past this quickly. Okay? So you take the free cash flow that a company is going to create from now on. But remember, see, a company is not just like a dividend that's going to get paid. A company makes more money over time, like Apple. They grow. Just because the population grows, because they get better at producing products, most companies grow, especially if they're S&P 500 companies. All right. So R is your discount rate, and G is your earnings growth. Don't worry about the algebra. That is a little more involved, intricate algebra, but it's really all the same algebra as the other stuff. Okay, but that's a course, so we don't need that. And if our discount rate is 10%, and if we assume somebody grows at 5% per year, we're going to get back to that. By the way, notice something. 5% a year minus 2% inflation, I've said before, gets you 3% real growth, which would be reasonable, which would be possible. possibly sustainable. Anyway, so this value, Apple, trust me, their last free cash flow was $65 billion. If I got the number right, I think I picked up the right number. And in our example, 10% minus 5% is 5%. 65 divided by 5% is $1.3 trillion. $1.3 trillion. So that would be the value of all of Apple, all the shares outstanding. Because that free cash flow wasn't for one share, it was for all the shares. All right. We're starting to see some magical stuff here because on April 3rd, the actual market cap of Apple was $1.1 trillion. Now, of course, it came down a lot because of coronavirus. Because that's what I've been saying all along. All these companies are overvalued. And now they got knocked down to a reasonable price. They're still not undervalued. This is not time to celebrate and think, the market's going to rally like crazy. So these last days, this last week and a chunk that have been up, I don't take great comfort as an investor. There's a lot more impact on our economy that is not being valued. If we talk about 20, 30% unemployment, right? A massive loss of revenue will occur in these companies. Many of them will go underwater. They'll go out of business. So the reason for trading now is a trader who takes advantage of price movements. You know, if you're an algorithmic trader or you're a smart trader and you figured out a way to make money every day these days, which to me sounds very difficult to do. But if you're skillful at that somehow, you've got a system, you've got an algorithm, you've just been at it, you've got experience, you sit around and you trade all day, maybe you can make money in this craziness. All right, here we go. If we have 1.3 trillion value and we divide by the 4.6 billion shares, we get $282 a share. Drum roll, what were the shares trading at on Friday? $241. See? So the math works is my point, right? Here's the price earnings ratio, something I've talked about a lot for Apple. We've made $241 is the price, and $12 was what they earned per share, 11 and 90 something. So their earnings ratio is 20 times. And I have said over and over that implied earnings growth is 5%. I've done a whole show showing that. If your PE ratio is 20, your implied growth is 5%. Okay? All these numbers are tying together incredibly beautifully because when I used that 5% growth, I got a share price that was accurate to the market, close to the market price. All right? So we get a AAA, triple plus for today's lesson. Okay. Why do actual stock prices differ from theoretical discount present value prices, right? Because they are a combination. Real stock prices are a blend. They reflect theoretical is part of what the prices they get because analysts are out there reporting all the time saying stocks are undervalued, overvalued. Here's what they mean. If it's a buy, that means it's undervalued. Buy it because it's going to rally. If it's overvalued, it's a sell because stock analysts give buy, sell, hold ratings. Okay, and so or they call them other things just to distinguish themselves. They say overweight, underweight, balanced, something like that. Okay, but what they're really saying is the stock they think will do well or not. And here we go. So that's the theoretical. That's what these analysts are doing. To their credit, they're trying to also put in a blend of the other stuff that's going on. But that other stuff is a more esoteric, more cloudy. I don't know what there's a better word, but you know, it's stuff where it's just judgment. News will affect. How does coronavirus news affect the market? What do you think? It swings like crazy. We've seen bigger swings in an hour than we normally see in a year lately, right? Especially for individual stocks. Insane because of news. Okay? Bond market value. By the way, a lot of the swings today, though, are just algorithmic trading. Way more than half of the volume on the market now is just these companies that have computers that are learning through artificial intelligence to trade better and better, and they're in a battle with each other, a battle of speed. And a lot of these companies never lose money because they never really are in a position where they trade unless they know they can buy cheaper and immediately sell quick, more at a higher price, even in fractions of a penny. Incredible. I'll do entire shows on that. Anyway, but news, broad market valuation. In other words, when the whole market moves, then all the stock prices move. So that's affecting your stock. That's called beta, by the way. I've taught that in other shows. Volatility comes from perceived risk too, especially by option traders, and volatility impacts stock price. And there's this psychology. If it's going up a lot, let's buy it. If it's been going up a lot forever, it's going to keep going up. It's going to keep going up. Well, we know that can't happen, but yet it's proven there is a trend that stock prices gain inertia, and they track as long as they've been going up, especially if it's been speeding up, how fast they've been going up, then rather than their price track what the theoretical price should be, they get above that. And so if you're a trend trader, you're not too worried, but you keep track of that tension. You keep track of the fact that, hey, prices are going to go, here's the theoretical price, and here's the actual price, and it breaks the theoretical price, and you hang on to it. You don't just sell it here because you don't want to miss these gains, the psychological gains, the trend gains, but you also have a number in mind that says, I have confidence maybe in it only going overvalued 2%, 5%, 10%, 100%, whatever is your judgment on that, right? Because the market has been rallying like crazy. It's been overvalued, theoretically overvalued, but there's no such thing as really overvalued. What is a stock worth? Whatever it's selling at. The price is capturing everything, including our emotion. So there's no such thing as a wrong stock price. And when I say a price is overvalued, I only mean theoretically overvalued. The actual price of anything is the price at which it is selling. There's no need to sort of fight that and resist that psychologically in any way. The value of anything is, especially something being traded all day long, nonstop, every single second. You know what the price is, the price that it's selling at. Okay. All right. And then there's this factor. It's real important. To some degree, stocks are overvalued because people have an investment account. I mean, their check being, what's it called? When money gets pulled from your check, there's a word. Money gets pulled from their check every payday, and it's a smart thing. That way you're investing in the market. I encourage it. But then even when the market is doing really badly, they'll keep pulling that from your check. And a more efficient investor will stop buying and maybe start selling if they see a crisis like coronavirus earlier on. Because coronavirus was definitely one where the signals were powerful. And when you combine that with the overvalued market, as I kept saying, even before I talked about coronavirus on the show, it's going to come down. It's a question not of whether it'll come down. It's a question of when it'll come down. Okay, here we go. So auto investment causes the market to be overvalued, and we love to gamble. So some of what drives stock prices up is more people buy them than would buy them normally because people just like to gamble. We get excited. And again, algorithmic noise and manipulation get reflected in the stock price. Okay? All right. Last couple of slides. How are stocks created? Okay, just to keep in mind, last 3-4 slides. The listing requirement on the New York Stock Exchange is $40 million in share value, and they have other requirements, but that's the most important one. So to get listed, you need more than that much value, and to stay listed, you need that much value, roughly that much value. I think the initial listing requirement and the permanent and the maintenance listing requirement would be maybe a little different from each other. I don't remember right now, but it's around the same number, if not the same number. Those rules have changed over time at times. The very appropriately, the markets, the New York Stock Exchange and the NASDAQ, they change their rules a little bit over time because the market gets bigger, etc. Just for common sense reasons. But I looked this number up yesterday. That's the actual listing requirement right now, New York Stock Exchange. And the average IPO, okay, IPO meaning when stock gets created, was for $260 million. So the average company that went public in 2019 raised $260 million. Okay, well over the $40 million minimum. Okay, now let's look at something. On average, S&P 500 companies' share price over the sales per share, or if you want all the market capital of the company divided by all its revenue, is about 1.5 times. A nice round number. It's very near 1.5 times. I mean like 1.52, 1.51. It's 1.5 times. That's been consistent for as long as I've ever checked it, which is amazing. Maybe not. Maybe it was lower before. Yeah, it was more like 1 time. That's right. And it's come to 1.5 times lately because of all this overvaluation of the market, theoretical overvaluation. Okay. So now we can take 260 and divide it by 1.5, and that implies that a typical IPO candidate has $170 million of revenue. What is my point? If you're running a company and you're wondering if you're going to go public, don't even think about it until you're selling at least $100 million a year of product. If you're selling $50 million, you can start dreaming and fantasizing and start calling investment bankers, and they'll zone you and they'll get you really hip to when you really call them back to do some business. But to call them, if you're selling $50 million of something, especially if you got a fat profit, call an investment banker at least on an informal basis. Find somebody who knows one and call one, and he'll go. If he's not on the IPO desk, he'll get you to somebody on the IPO desk, or he'll know enough to tell you, to guide you. Okay, here we go. But yeah, the point is, if a company wants to go IPO, have an initial public offering, They are already humongous and they are successful. Here are the steps. The candidate calls an investment bank and they call their underwriting team, the IPO team, underwriting team, and the iBank, okay, the investment bank, iBank, okay, they create a calendar of all the tasks. If the investment bank thinks it's a plausible candidate, a very plausible candidate, a shoe-in, they don't even go with you if you're not a shoe-in. You've got to be so strong that they don't, for them to talk to you, that no one gets in the door that's borderline. What does happen sometimes is IPOs don't happen because there's a fantastic company, but some situation changes radically, either for the company legally. Think of Lyft and all the legal problems they've been dealing with. Are we a employer or not? Are our drivers contractors or are they employers? I'm amazed they got through their IPO and they did well. Anyway, or the market just goes nuts and goes way down, and now you don't want to do your IPO. You want to wait till it recovers. There won't be almost any IPOs in this company, period. I don't know if there have been any in the last few weeks. I'm guessing none. Any IPO that was scheduled probably was pulled. I didn't check that. But IPOs come out a number of IPOs come out every week during the normal year, except very few during the holidays. But other than that, IPOs come out all year. And so I'm guessing 20, 30, 40, 50, 100 IPOs were canceled. Big ones. Okay. Here we go. So then you create this calendar of all the tasks everybody's going to do. And this thing is detailed, right? It's a typical 6 to 9 month calendar. And it says what the iBank will do, what the company will do, the lawyers, the accountants, what the listing market will do, like New York Stock Exchange. All kinds of other entities are involved. You don't need to know. If you want to know more, you can look it up. You prepare public style financial statements. So when you're a private company, you get to keep your books adequately to fill your taxes, to do your taxes, which is quite a lot of work. You're going to have a professional accountant doing this. If you're a significant company, you've got an accountant. No serious grocer, et cetera, is just doing their own books without having a professional accountant. Okay, so you're doing your accounting and you're keeping books now, but to get those books into the right form and format and completion and detail so that they'll be pass an audit so that they can be ready for a public company is a hugely much more larger ordeal. A lot more systems, security has to be put in, and the auditors have to be able to pull a lot of data efficiently. If they can't, you got to put that functionality in your system. Huge amount of work goes in because this is massive for a company. This is another reason small companies don't bother, because this is millions of dollars right here. Just that line right there. It could be $1 million, it could be $20 million for a bigger company to get this all to work. This is why it could take a year, 2 or 3, just preparing, just to make the phone call to call the iBanker, because that might be what he'll tell you. He'll give you a quick idea of what you need to do, and you may beef up your accounting and a lot of other stuff, your security, all kinds of things. Okay, so the iBank will guide the candidate through writing what's called a preliminary offering memo. They call it a red herring at first because it's got red stripes on it, because it's a warning. It's a preliminary memo, and it looks a lot like a 10K. The annual report that I said is 100, 200 pages long. Offering memo has a lot of the same information as the 10K. Very similar. They're even the sections file similarly to in the 10K. There are differences, but if you've read a 10K, you'll understand an offering memo. If you've read an offering memo, you'll get a 10K. There's a lot of overlap. Okay. Then you register your securities. Now you're really been working for a long time and you're really ready. And you show the security, you do all the forms you fill out that essentially look like a 10K. That's that filing. Okay? And the offering memo. And you give that to the Securities Exchange Commission. And they've got a basic form that you have when you do anything when you register. Your name, your address, the names of the officers of the company, names of the board of directors, basic stuff. Okay. The iBank syndicate, now you have a syndicate of banks because between the company and the iBank, you choose a group of iBanks that will support you. You have a lead iBank that you've chosen, and then you get the other iBanks that are going to be there the day you go IPO, because no one iBank can collect as many orders to sell your stock and blow them out the door, it's called, as fast, as great a price by themselves. No one bank can do it as well as if he gets a whole group of 6, 7, 8, 9, 10 banks, depending on how big the IPO is. A typical syndicate, I'm going to remember, is 6, but they could be way more depending on the size. Okay, on the morning of the IPO day, this is huge. This is 6, 9 months of work. The syndicate all takes orders. Now, what they've been doing is showing the offering memo to investors for a while, and they've already got a good feel. They've been constantly updating the company and the iBank. They have calls toward the end every day, several times a day. And one of the things they check every single call is how many prospective investors, the guys on the underwriting desk think they have collected. And who are they talking to? How do they get these? They talk to what they call the sales desk. The sales desk buys and sells stock all day long, including IPOs. So the sales desk doesn't just do IPOs. Sales desk at the investment bank talks to many, many investors, including those guys they think we're going to buy for the IPO. So they've got every guy on the sales desk has this little spreadsheet. He's keeping track of people that might buy and how much he thinks they'll buy. And he keeps talking to them. And he's playing the game of selling a lot of different stuff all at the same time. There could be various IPOs during 1 week. And a given salesperson might believe a lot more in the GE IPO. Well, GE is in trouble now, but you know what I mean. Somebody could believe a lot more in the clock IPO than the lamp IPO. So there's a lot of stuff happening, a lot of data being collected, a lot of work going on. When you're going to bring a company and make it public, it is a spectacular thing to be a part of, to live through, that I've been fortunate to live through and to see happen, right? And to see all the pieces fall in place, all the talent and work that goes in, the sweat, the attention to detail is remarkable. Okay, so boom, what happens on the morning of the IPO day? I should have made this one red. You take orders until the book is so-called filled, and it's really overfilled, which is called oversubscribed, and you finally decide. At first you came out with some preliminary number of shares that you think you were going to sell. You even had that in your registration with the government, but you don't have to sell that many. You can sell a little bit less, a little bit more, no problem. Typically, companies sell a little more. They play it safe when they register. Here's what you have to do, correction. What you do with the company, though, is government, you register way more than you think you can issue. And that way you have plenty of authorized shares, okay? But then you sell the actual shares outstanding. And then you have authorization by the government and by the board of directors to sell even more shares if you like. You have a lot of wiggle. And I'm going to take a wild guess. You authorize 2 times, 3 times, 4 times what you think you're going to sell. Quite a bit more, okay? All right, so you've got a lot more shares registered. Nevertheless, you've given the government a flavor for how much money you think you'll raise. And there's some simple math for the government to know how many shares you probably will issue. Happens all day long. It's a routine process going on at the Securities Exchange Commission. They have a big office. It just does this all day long. Okay, update. Once you've issued your shares, and you've made the founders very wealthy that day. Then you complete the offering memo to reflect final price, final fees, and you file that with the SEC. Okay, and investors receive their shares on T+2, meaning 2 days later, and the investment banks split around 4% in fees that they get. So a typical IPO, $260 million, $10 million of fees go to the investment bank. So the investment bank makes $10 million each time they go out and make a lot more on bigger deals. So you hear about an IPO, you've got a team of investment bankers, maybe 10 people who generated $10 million of revenue. They worked on it for 6 months, but they don't work on the one deal full-time for 6 months. They're juggling a few deals at a time. So depending on the team and how busy they are, how many deals do they do a month, any given team? Tough for me to estimate because I've not been involved in that process enough to know. I'm going to guess 1 a month that they get done. They crank out 12 great deals a year. So a given team, because they create teams, groups within the investment bank that work together, they get used to working together. They're generating, each team's generating $100 million of revenue for the bank. And it's not a big team. It's 20 people, 30 people generating $100 million. This is why they pay them so well. All right. Why work so hard? Well, the IPO, like I said, takes 6 to 9 months. And most people involved, certainly investment bankers who do this for a living, work extraordinarily hard. You don't want to hear the hours. These are people that, have challenges keeping marriages working and all that kind of stuff. Although they do it. I know many of them who do it successfully. All right. And they're as many of them are as family oriented as anybody. Family oriented. Okay, here we go. We're at the last bullet points. But certainly on the company side, anybody who's done an IPO, ask them how hard the work was. I would bet a lot of money they're going to say that's the hardest work they did in their life, in both dimensions, both in the amount of work, but also in the amount of focus that it takes to get this work done because of the number of pieces, the number of people involved, the amount of communication that happens. Now, when you're a person that normally got a lot of emails a day, you're reading hundreds of emails a day. You're writing dozens of emails a day. You're attending many meetings a day, especially if you're the man and the people reporting to the main founders. Okay, this team work incredibly hard, and it's something I admire greatly. Human beings that work that hard at something and succeed, and it's a wonderful thing. So why do they work so hard? Well, how about Lyft? They're filing 250 pages. of work. They raised $2.3 billion, and the founders came out with about $160 million of value, and they had 20 times voting power. So they had 160. There were two guys. They had 160 million bucks in their pocket. I'm guessing that when they started off with Lyft, they didn't have 160 million dollars anywhere near that in their pocket. I won't be surprised if they had nothing in their pocket, and then they ran Lyft for what, 5 years, 10 years, and then they have 160 million dollars. Not bad. That's why people work so darn hard. So that's it. We made it through the show. I am Al Mora, getting back on my main screen and telling you, I hope that you hung around, watched the show. I hope that you learned from it. I hope a lot of you saw an income statement, balance sheet, cash flow statement, who saw it for the first time. Appreciate that you were seeing what you own a little piece of. And imagine all the work all those people are doing if you own the shares of a company to create those financial statements that we looked at. So when you buy a company, you are buying an organization that is run professionally, ongoing. Every one of them probably has, not probably, every one of these companies has a beautiful history. All right. They have the history of where great grandpa founded the company, and and it was for generations. It was this, they made stuff by hand, and they made it by machine. They made it in a garage or in a barn, and then and they hired 20 people, and then they hired 40 people, then they had 100 people. And finally one day this guy, somebody goes to college and gets a degree, and he's an accountant, and he's in the family, and he helps run the business, and he goes, hey, guess what, Dad, Mom, I just watched Al Mora's Get MorAlpha show, and guess what? It's time for us to go public. Wouldn't that be amazing if someone watched my show, this show here, and got inspired and said to themselves, I'm taking somebody public because Al Mora showed me the dummies from Lyft. They did it, so I could do it too. So I encourage you, learn about investing, invest, open an account, watch more Get MorAlpha shows. What am I trying to do? I'm trying to get a following. I'm trying to promote individuals investing on all scales. I also am trying to promote, I haven't been able to do it, but I'm going to get the work done at some point, and some sort of an effort to protect investors all around the world, and to make investing accessible to everyone in the world. Every human being can have a cell phone and can invest on their telephone. Why not, right? Can you imagine what an amazing thing it would be to lift Africa from the struggles it has faced? Africa, our birth, our cradle, right? Our family who are there, who are somehow still thriving. It's amazing to me. 1.2 billion of you in Africa. I think of you all the time. Anyway, so I connect all these things. I connect the dots. And then looking at all of this philosophically, okay, I want to look at coronavirus briefly philosophically. End of the show. Here it comes. And that is, let's keep our chin up no matter what we may endure. No matter how this may touch our families and us as individuals. Let's make this our finest hour. We have Winston Churchill to inspire us, and we have all of human history to inspire us, because what hardships haven't our forefathers and foremothers, borne? What haven't they borne since the beginning of this species? What haven't they heroically overcome to help us be to the point where I am online projecting a show all over the world that could be watched all over the world to teach you about something called investing and to teach you formulas, right? So, Al Mora, host of your Get MorAlpha show, the show that will give you more alpha than any other activity in your life. And alpha is always a great thing to have. Checking out. Good evening. Please be careful. Please take the best care of yourself, including emotionally. Please take great care of yourself.